Once you understand what you're expected to pay for college, a term called student aid index, or the old term was expected family contribution, and the role that financial aid will play in your paying for college plan, it's time to start saving. I don't care who you are, every family is going to pay something for college. So we need a vehicle to save for this future expense. My name's Monica Felton, and I've been helping families save and pay for college so parents don't wreck their retirements. And what I've learned after over 15 years is that the vehicle that you ultimately save in for the college expense is really about the benefits that that vehicle will give you. So today we're going to cover 8 of those vehicles and all the benefits that might be available for your money. So let's get started. On the left-hand side, this is a list of all the benefits that you can receive from your money. Now, in college, I have type of family because this matters. Are you going to be a need-based family, which means we want to maximize the amount of aid you're eligible for, or are you a full pay family? Financial aid invisible. Will the vehicle that you're saving in count against you with financial aid? Tax deferred, that means that you're not paying taxes on the growth of the investment. Tax free means that I don't have to pay taxes on the gains when I use the money. Market risk, what that means is that I'm able to invest in the stock market. Again, that could be a good thing, but remember, the market goes up and the market goes down. Competitive rate of return, what this means is that you're in the market or able to get a nice rate of return. And forgive me, you don't have to be in the stock market to get a nice rate of return. Guaranteed means that there's no loss. Your money is guaranteed so that when the time comes to pay for college, you know your money's going to be there. High contribution limits, I can actually fund this with enough money to cover the full cost of college. And then transferable, meaning I can move it from one family member to the next. We'll start with a 529 plan because this seems to be synonymous with college planning. Remember, a 529 plan is a government vehicle. The money, you make contributions, and in some states, you are eligible for a tax deduction. The money grows tax deferred, and when you use the 529 money for college, then there's no tax on the gains. A 529 plan is a single-use plan, which means the money can only be used for college. If you use the money for anything else, the government will charge you a 10% penalty at withdrawal. If we look at family types, I'm a big proponent of 529 plans for uber wealthy families. If your retirement is secure, you're not concerned about mom and dad, your future at all, certainly save in a 529 plan. The growth is tax deferred and you can use it on college tax free. But should you need that money for anything else, it becomes very punitive. It does count against you for financial aid. A 529 plan is considered a parent asset. As discussed, it grows tax deferred and it comes out tax free as long as you're using it for college expenses. You will be invested in the stock market. You can get a competitive rate of return, and no, the money's not guaranteed. So should your student be going to college when the market is down, you will take a loss. You can have high contributions and the money is transferable, meaning that you can move it around in your family. Next up is a UTMA account or a UGMA account. This is a custodial account that's in the name of your child. This is, again, for wealthy families. In this strategy, using a UTMA account or a UGMA account, we shift resources out of mom and dad's name, move them into the student's name because taxes are paid at the student's rate. UTMA account and UGMA account are very punitive to financial aid. So if you're a need-based financial aid, this is the wrong place to be saving money. It is not tax deferred. It is not tax free. You can invest those monies in the stock market to get that competitive rate of return. No, the money is not guaranteed. Yes, I can put as much money in there as I want, and it is not transferable. That money must be used for the student that it is intended for. Properly structured cash value life insurance. This is one of my favorite savings vehicles because it's for all family types. A cash value life insurance contract is properly structured to squash down the death benefit so that we can get as much cash inside of this vehicle to receive all the benefits. The money in this account is financial aid invisible. It will not count against you. The money grows tax deferred and it comes out tax free when we borrow against it. I can certainly explain this to anyone who's interested in talking, but it does grow tax deferred, comes out tax free. There is no market risk inside of a properly structured cash value life insurance policy. You will receive a guaranteed competitive rate of return on that cash value. You can put a whole bunch of money in there and it's transferable. Mom and dad, not only can you use cash value life insurance to fund college, but you can also pay for braces, cars, weddings, and ultimately a tax-free retirement for you. This is what we call a multi-use account, meaning you can use the money for anything you want. A Roth IRA. I'm a big fan of Roth IRAs. Again, you need to be a need-based family though, because there are contribution limits. So if you make too much money, you actually cannot fund a Roth. A Roth is financially aid invisible. It does grow tax deferred. And when we pull the money out, it comes out tax-free. With a Roth IRA, you're usually invested in the stock markets, stocks, bonds, and mutual funds, which will give you a competitive rate of return. It is not guaranteed. You cannot put high contributions. Your contributions into a Roth are based on your adjusted gross income, but Roth you can use for college. And you can use it for retirement as well. So I would call a Roth a dual purpose account because you can use the money for college, but you can also use that for retirement. A traditional IRA, again, a need-based family, because to contribute to an IRA, there are those income limitations. A traditional IRA is financial aid invisible. The money does grow tax deferred, but when you pull the money out is when you're paying taxes. Remember, an IRA, you do not save taxes. You are postponing taxes to the future, usually in retirement when you withdraw the money. The money's invested usually in the stock market, stocks, bonds, mutual funds to get that competitive rate of return. There are no guarantees with an IRA. You can put in contribution limits and the money is transferable. Prepaid tuition. This is becoming a bit of a dinosaur as we only have 7 states in the union left that are allowing prepaid tuition. We're in the state of Arizona and we do not have one. All families can put money into a prepaid tuition plan, but remember, you have to go to the state of the plan to actually receive those benefits. It is not financial aid invisible. It is tax deferred, but you will pay tax on that money. There's no market risk, a competitive rate of return, because it is inflating with the school tuition prices. It is not guaranteed. There are not high contributions, and it is transferable. A Coverdell. A Coverdell, again, is a government savings plan for college, and really, I would say for need-based families. You can only contribute $2,000 in a year into the Coverdell, which is why there's not high contributions. It is not financial aid invisible. It does grow tax deferred, and you can pull it out tax free as long as you use that money for college. There is market risk involved, a competitive rate of return. It is not guaranteed. Again, you can only contribute $2,000 a year, but we can transfer that amongst our family's members. And lastly, this would just be a brokerage account or a cash account. So all families can save inside of these. A brokerage account is definitely a multi-purpose account because you can use it for college or braces or cars or even retirement. It is not financial aid invisible. It is not tax deferred. It is not tax free. There is market risk, right? We invest usually in stocks, bonds, and mutual funds for that competitive rate of return. The money is not guaranteed. I can put lots of money in here, and it is transferable. I can use it for whatever student I want. So when you begin to think about where you want to save money for the future expense of college, the bigger question is, what benefits do you want to derive from your money? My recommendation is to find all green, because if indeed we don't need money for college, we want to be able to repurpose that money to other things. So multi-purpose accounts with multi-benefits are my favorite places for you to save for the future expense of college.